Okay, in this video, we're going to go over the put option. Put options are a bearish strategy. They're less intuitive, so we'll spend some additional time looking at them, but it's similar to buying an inverse ETF, right? An inverse ETF moves in the opposite direction of an ETF. So, just like a put does from a call, the profit is going to move in the other direction. A put option gives the buyer the right to sell 100 shares of stock at the strike price. Okay, so call options, we are buying at the strike price. Put options, we are selling at the strike price. This strategy is bearish, meaning we want the stock to fall. And the option is successful when the stock price is below the strike price at expiration. So let's look at an example here. We have Apple. It's trading at 380. We think the stock is going to fall, so we buy a put. The strike is 370. The expiration date is 60 days away, and the premium we're paying is 290. Remember to multiply that by 100, so the full cost of the option is 290. What we are expressing with this trade is I believe the stock price of Apple will be lower than 370 in the next 60 days. Now, the trade outcomes at expiration. Let's say that Apple moves down to 365. This is a successful option. Why? Because the stock price is below the strike price at expiration. What we are doing is we are selling 100 shares at the 370 strike and then buying them back at 365. So we're making a profit of $5 a share for a gross profit of 500. But remember, we paid $290 in premium to buy the contract. So our net profit is 210. Now, let's say that Apple moves up to 385. The stock price is now above the strike price and we lose our whole investment. The option is worthless because it doesn't make sense to sell the stock at 370 and then buy it back at 385. Nobody wants to do that. So the put option is worthless. So that is the put option. If that's still a little confusing, don't worry because now we're going to go into Thinkorswim and take a look at the risk graph.